Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 7th of May 2023 and we're publishing our gold and silver weekly update for the week ending the 5th of May. Last week we saw some major moves in both gold and silver prices which looked for a moment as if they were going to shoot to the moon, but reality then settled in. Let's take a look. Now first, just a quick reminder that we've set up a second channel entitled Finances Do Matter. We now have 60 videos on that channel and 3,000 plus subscribers. It's growing quickly, and if you haven't subscribed and wish to do so, we've placed a link in the description box below as well as in the comments section. For those who wish to keep track of our annual gold and silver price forecast for the year, which we publish in January, we've also placed a link to that video below. Well, last week was exciting, both for gold and silver prices and of course for those living in the UK and those who support the monarchy elsewhere, as we had the coronation of King Charles on Saturday. And what a spectacle it was. Whether you're a monarchy supporter or not, one cannot be but impressed by the pageantry and the status that this sort of show, for the want of a better expression, actually provides. And I haven't seen the figures yet, but it is anticipated that over 1 billion people tuned in. We shall see how close to that figure the reality is. Now, looking at other important figures, which are gold and silver, we can see that gold rose $27 last week, rising from $1,990 to $2,017, having been as high, wait for it, as $2,091, yes, just $9 short of that $2,100 level, and a low of $1,978, so a rise of 1.4%. In sterling terms, gold finished the week at £1,598, that's up £13, and in euros it closed at €1,831, that's up €23. Silver rose 61 cents, rising from $25.07 to $25.68, having been as high as $26.16 and as low as $24.60, a rise of 2.45%. In sterling terms, it closed at £20.36, that's up 37 pence, and in euros it closed at 23.34 euros, that's up over half a euro. The gold to silver ratio fell from 79.4 to 1 to 78.5 to 1. Now the difference, and it's quite interesting to look at this, the difference between gold's high and low was $113 compared with $34 the previous week. And the difference between silver's high and low was $1.56 compared with 86 cents the previous week. So clearly that difference between high and low for gold was far more impressive and more rare. Now this is what we said last week concerning our forecast. Quote, we can expect wider margins for gold and silver this week compared with last week and more excitement in the markets. We expect gold to trade between 1925 and 2050 with 1900 and 2075 as outliers, and silver to trade between $24 and $26 with 2350 to 2650 as outliers. For the most part, gold traded and closed within our normal trading range, but did rise a little above the top of our outlier range on Wednesday evening, that's UK time, but it lasted for just a few minutes or moments and then fell back within our normal trading range. Silver did likewise, but it spiked a few hours after gold, but that spike did not fall outside of our outlier range, and like gold, closed within our normal trading forecast. Now before we look at this in more depth, let's look at other financials. Bitcoin currently stands at $28,867. That's down just $436. It's been considerably higher than that as well during the course of the week. Equities were, well, I'll say broadly lower, though they did rise on Friday. But for the week, the Dow Jones closed down 424 points at 33,674. The S&P closed down 33 points at 4,136. But the Nasdaq broke the trend and closed up 9 points at 12,235. Good news for inflation and those of us who use fuel. Brent crude closed at $75.30, that's down $5.03. And WTI crude closed at $71.34, down $5.44. Let's hope we can continue to get this downward trend, though I suspect that may not happen indefinitely. The dollar index stands at 101.24, that's down 0.42 points on the week. Now, looking at last week's US data announcements, we saw that manufacturing indices were broadly as expected, and factory orders were 0.4% lower than anticipated, but higher in March compared with February. The ADP employment report on Wednesday came in strong with 290,000 new jobs for April, compared with 142,000 the month before, and against expectations of 133,000, and that should have warned markets what was likely to happen on Friday. Services PMIs were virtually as anticipated for April. Now, Friday's US employment report shocked markets, really, somewhat in that April recorded 253,000 new jobs against expectations of 180,000. And that compared with 165,000 new jobs the month before. Hourly wages were up at 0.5%, compared with 0.3% the previous month, and the unemployment rate ticked down from 3.5% to 3.4%. I'll talk about that a little more in a moment. Consumer credit figures for March were up over $10 billion compared with Feb's figures. That might suggest something, and that's in spite of an increasingly restrictive credit control policy. Now, the sizable increase in jobs last month is not what the Federal Reserve wanted to see. The central bank hoped the labour market would cool off and ease the upward pressure on wages. Fed officials believe rising wages could make it harder to get high US inflation under control. If the labour market remains strong, the Fed could be forced to come off the sidelines and raise interest rates again, putting the US closer to recession. Rising rates have historically led to economic downturns. Now, on Wednesday, the Fed did raise its key short-term interest rates by 0.25%, and that's its 10th increase since March 2022. Fed Chair Jerome Powell suggested the Fed could pause further rate hikes to see how inflation and the economy responds to the sharp increase in borrowing costs over the past year, though he did become a little bit more hawkish after he gave the statement and then talked to the press. Now, on Thursday of last week, the ECB raised its rates by 0.25%, and next Thursday we're expecting the Bank of England to do the same. Now, you see we have inflation in the US around 5%. In the European economy we have inflation at 7%, and in the UK around 10%. And of course all of the banks and all of the countries are targeting 2% inflation. And it was hoped that whilst the ECB and Bank of England may probably have another 2 rises to go before they can contemplate pausing, the Fed hoped last week would be the last rise, either for a while or hopefully indefinitely, and that we could actually see a pivot in policy and see lower rates. We're almost certain that's not going to happen in 2023. You see, the strong performance of the labour market, although dampening expectations of an immediate recession, which is good, also reduces the market expectation of rate cuts, if not increasing the opportunity of one more rate rise. Now, we've stated from the beginning, and we're going back 12 months, that we believe the Fed funds rate should be at or around 5.5% to work, whereas currently it's 5 to 5.25%. The Fed and markets are hoping that credit restrictions will prevent the need for a further rise. This coming week, watch out for 2 Fed governors speaking on Tuesday to get a flavour of what they're thinking, but pay particular attention to the CPI and core CPI figures due out on Wednesday. We then have the producer price index on Thursday and the import price index on Friday. Now, this is the important bit. The FOMC will not have to decide whether to raise rates now until the 14th of June. Before then, we'll have another US jobs report, which is due on the 2nd, and a further inflation report, which is due on the 13th, day before the decision. These 2 indices will then, in our view, set the scene for the following 3 months, because whatever the Fed decides then on the 14th of June, they will probably hold on to for a 3-month period. Gold demand is rising, and we're witnessing strong support around the $2,000 level at the moment, and resistance at 2,100. We have silver support at 24 and resistance at 26. Although it did slip above that slightly, it certainly came back down. The $24 level seems to be, though, where buyers start to re-enter the market. Now, we saw clearly profit taking on Friday, and next week, of course, the CPI figures on Wednesday would be important, and potentially market moving, at least for the short term, until we see the June figures. So, with this in mind, we can still expect to see some broad margins for gold and silver this coming week, but we suspect not as large as last week. Therefore, our forecast for this coming week is for gold to trade between $1,950 and $2,075, with $1,900 to $2,100 as outliers, and for silver to trade between $2,450 and $2,650 as a normal range, with $24 to $27 as outliers. What do you think? Please share your thoughts. Let us know where you think gold and silver are going to move this coming week. Now, before we go, just another reminder, we've placed a link in the description box below for our Finances Do Matter channel. Please sign up to that, and please start paying attention to that, because we are doing more videos on that channel than we are here on Illuminati Silver, but we are covering a wider range of subjects. And as time goes on, Illuminati Silver will focus more specifically on gold and silver issues. Thank you again for watching. Please give us a thumbs up, subscribe, press that bell sign, pop over to Finances Do Matter, and we'll speak to you soon.